video is on the direction of the stock market, primarily the U.S. stock market, although we'll get into other markets, relative performance, relative strength of the U.S. market, the S&P 500 to other components. My name is Ben Rippon. Today is April 19, 2022. Welcome. We'll begin with the S&P 500, showing you the direction of the S&P 500. Now, the S&P 500 is an index, and it is made up of large cap stocks, the largest 500 companies in the U.S. stock market. And those include both value kind of companies and growth kind of companies, but they are all large companies. But it's used commonly as a benchmark. You can see over the last year, this is a weekly chart for the past year. Every move represents 1 week of movement of the S&P 500, and this is the tracking stock ETF SPY. And you can see for most of 2021 that the market, the S&P 500, was in an upward trajectory. Since late December, the S&P 500 and the market in general has been in a downward trajectory and is now not only moving down, but it is below its 20-period moving average. So this becomes kind of a benchmark, a baseline for everything else that I'm going to show you. So you can think of this as the U.S. stock market. When you take the S&P 500 and you separate the stocks in the S&P 500 into two groups. One group is growth and one group is value, two very different kinds of companies. Those more focused on revenue and growing, and those more focused on profitability and value. When you break this apart, you can see for about half of the past year that the general trajectory was up. And what that means is in the relationship of growth over value, numerator, denominator, that if it's going up, that favors growth. Since late December 2021 to present, you can see that value is in favor and growth is out of favor. You'll see this in some coming slides. So right now we're in an environment where value kind of companies are doing much better than growth companies. When we compare the S&P 500, the entire S&P, which includes value and growth, when we compare that to the small cap index, the exchange traded fund is IWM. When we compare that, SPY being the numerator, IWM for small cap being the denominator, we can see that over the past 12 months, the trajectory has been down. And what that means is that the S&P 500 has outperformed the small cap index by this much. And so it continues to be, the small caps continue to be out of favor. I'm going to expand the chart to a 24-month chart from a 12-month chart. It's still a weekly, so every move still represents 1 week, and it gives a better picture so that you can see, in this case, the long-term government bonds represented by the exchange traded fund TLT. And you can see these two long periods of decline. The overall trajectory is down, but it is more sharply down during these two periods, including the current period. This goes through Friday, April 14, but then when you project it on into Monday, the 18th, bonds, long-term government bond, down even more. When you look at the Vanguard extended duration government long bond, the ETF is EDV, you can see that this, since the 25th of November, is down 27%. Now, what's significant is, remember, bonds are intended to be an antidote or an offset for equity risk. Where is the protection? When stocks have been down during this period of time, where's the protection? It's not there. Bonds are no longer protecting stocks. At some point that will change. But as long as interest rates are going up, bond prices are coming down. Regardless of what equities do, bond prices are coming down, and the traditional 60-40 stock bond portfolio or the buy and hold strategy, I think, is waking up investors. And I have no idea what financial advisors are doing, but that use traditional approaches. But I'll just say it this way, I wouldn't want to be in their shoes. Okay, let's go over to precious metals. Gold, while equities have declined and bonds have declined even more, many of them, gold has actually been rising. So you can see over a 24-month period the kind of the opposite direction. Gold is going up while equities and bonds are going down. Now I switch over, it's a 24-month chart. Now I switch over to silver, very similar, but there are differences. So silver and gold in general have been increasing in value, and both of them are above their 20-period moving average, which is a positive sign. When I compare silver to gold, silver numerator, gold denominator, this is what it looks like. So if it's going up, it's going to favor the numerator, in this case silver, and when it's going down, it's going to favor the denominator, which is gold. So you can see from the black arrow and the red arrow how that works. They're both going up, but silver in the last year or so has gone up less than gold has. However, I put this in there because I can see a shift occurring at least for the past 4 months, that silver is actually starting to increase in value faster than gold. That's a short-term trend. We don't know if it's going to continue, but it looks like it's sort of broken the trend line, and silver might come more into favor. This shows the major indexes, the performance of them over the last week, the last month, the last quarter, and year to date. I focused primarily on year to date, and it tells quite a story. When you think of buy and hold portfolios being stuck in something like this, this is not very good. So you can see the very best performer was the Dow, represented by the ETF DIA at the very top. I underlined that with a yellow line, and that is down about 5%. So it's the least worst. I will say it's the best. It's the least worst. The next one is represented by the blue line is QQQ, which is the NASDAQ 100 major index, down 14% since the beginning of the year. It gets worse. Bonds, remember we looked at TLT as the exchange traded fund for the government long bond, down 19% since the beginning of the year. Again, bonds like this are used for protection, hopefully go the opposite direction from stocks, protecting stocks from downside risk. Where is that protection? It's not there. And then finally, represented, underlined with a pink line, is the NASDAQ 100, the technology sector segment of the NASDAQ 100 is down 20%. And this was the hottest component the first 8 months of 2021. Interesting how times can change and how these can change places. If you follow Kathy Woods, the CEO of the ARK funds, some people follow the ARK funds. They were hotter than hot during part of 2021. These are the innovation exchange traded funds. They're called the ARK funds. ARK-K, which is the Technology Innovator Fund, year to date is down 40%. Okay, now I'm going to take the four major indexes for the U.S. market, the Dow, the S&P, the NASDAQ 100, and the small cap Russell 2000, and the two foreign indexes, the developed markets by EFA and the emerging markets represented by the ETF EEM. This shows the percentage gain or loss weekly, monthly, quarterly, year to date. But then it shows, I put a dashboard together to show you where they are relative to their 20-day, 50-day, 100, and 200-day moving averages. Are they above those averages or below? If they're above, that's generally speaking somewhat of a positive sign that they're moving in an upward direction, or at least have not fallen below those moving averages. And all of them, except one, is below their moving averages, and that's the Dow. And it's only above the 50-day moving average. It is below all the other averages. So there are, I count these, there is one green light. Last week, there was 2 green lights out of 24. So today, there are 23 red dots. They're below their moving averages, and only one is above one of the moving averages. This is an extremely interesting chart to me because it shows that we are living in a divided market. The market is separated, you could say bifurcated, but in 2 different components. There are 5 sectors in the S&P 500 that are above all of their moving averages. They're all above the 20, 50, 100, and 200-day moving averages. All of them above all the averages. And yet there are 6 that are below all of their moving averages. Usually it's a little more mixed up than this, but this shows that there are 6 that are in deep trouble, and there are 5 that have actually held up pretty well. The 5 that have held up well are energy, consumer staples, healthcare, basic materials, and real estate. Those that have fallen below those moving averages are financials, which is banks and brokerage companies, industrials, telecommunication, consumer discretionary, retail, and of course, no surprise, technology. The Asbury has some charts that measure market strength, and they are negative on 5 out of 6 of their primary indicators. They do an asset flow showing where the money is going to and where it is coming from. It's interesting. So I'm just going to look at, they do it on a weekly, monthly, and quarterly basis. I'm going to just look at the weekly. And they take 2 in each category. Where money is leaving, flowing out of, is technology and consumer discretionary. Look at the previous chart, you can see that. And where it is flowing into are more defensive sectors, energy and consumer staples. Again, no surprise, it matches what I just showed you. They do a relative strength, relative performance based on asset prices of ETFs in each of these sectors. And I'll just point out the ones that where there is the strongest outperformance. Low volatility versus high volatility. No surprise, we're in a defensive environment. Low volatility is doing better than high volatility. The Dow versus the S&P, or the NASDAQ for that matter, Dow is doing better. The S&P versus the NASDAQ, the S&P is doing better. and value or growth, value is doing better. All of this matches with the previous charts that I just showed you. When you get into fixed income, into bonds, they're all doing very poorly. We've covered that. Which ones are doing less worse? I guess that's a phrase, less worse. Government bonds are doing less worse than corporate bonds. And high yield doing less worse than high quality corporate bonds, and short term less worse than long term bonds. All of this are bearish indicators and indicate a declining market. The U.S., compared to other countries, we can see the countries where that are performing better than others. And the most pronounced ones are Australia, Switzerland, Malaysia, Spain, United Kingdom, Mexico, and Brazil in weekly, monthly, and quarterly views. So it is no surprise that these have stayed in this pattern. The U.S. is not on any of these charts as far as significantly outperforming these other markets. So I thought I would just each week I take one of them, and this week I'm taking the UK and showing why it is stronger. The UK is stronger. They're all stronger. The ones I've pointed out are stronger than the US, but I'll show you an indication as to why that looks that way based on the weekly, the monthly, and the last quarter. It looks like this. This would include, this is a 12-month chart, UK versus US. So you can see during the last quarter, it has outperformed the US, and during the last month and the last week has outperformed the US. So this is a relative performance chart comparing UK as the numerator, US as the denominator. With the market's recent volatility, the position I'm most comfortable with is the fetal one. Thank you for watching. I'm doing 2 other videos, one on inflation and one on coming recession. And you can look at those if you're interested. I give a lot of backup material for them, and feel free to leave questions and comments. I respond to all of those. Thank you for watching.